Consumers are feeling more upbeat in October thanks to central banks around the world starting to cut interest rates and inflation in Australia gradually returning to the target band. The Westpac Melbourne Institute Consumer Sentiment Index has just posted its best result in 2.5 years. For more on this, I'm joined by Westpac's Head of Australian Macro Forecasting, Matthew Hassan. Matt, thanks for your time.
Hi.
Consumers most positive in 2.5 years. What's got them pumped up again?
It's really the prospect of maybe finally inflation coming out back under control and the door opening to interest rate cuts. We have an additional question we ask around expectations for mortgage interest rates. That dropped 14% in the latest month. It's down by a third from July. Basically, 50% of Australians expect rates to be unchanged or lower over the next 12 months. Back in July, it was barely 25%. So we've had a big swing in expectations around interest rates. That's helped to calm down some of the fears that were emerging around the outlook for the economy and prospects for jobs. And at the margin, probably provide a little bit more support to expectations around family finances. They're still doing it pretty tough. Confidence overall is still in pessimistic
Historically
territory.
Still low, right?
Yeah, still quite low. But we've gone from 75 to 85 range persistently over the last 2.5 years to now just shy of 90. So 10 percentage points below neutral. And that's a significant improvement, the best we've seen in 2.5 years. And there do look to be some promising prospects. In terms of the pressures at the moment, they're still mainly around these cost of living issues. Family finances compared to a year ago. They have improved over the last 3 months, that reading, but it's still deeply negative. Even with tax cuts and fiscal supports, people are struggling to make ends meet, let alone get ahead. And consumers expect that to last a little longer, basically things to stabilise over the next 12 months. But in terms of the trend, this is the first really quite promising positive sign that we've seen in quite a while.
Yeah, well, I guess you think about some positive news. We saw the monthly inflation indicator recently show it's down to 2.7% in the RBA's target band. So I guess people would have seen that and thought, hey, this is a good sign.
That's right. Hey, maybe we're going to get this after all. Of course, that update was post some of those fiscal measures which have impacted the headline. But even still, the trim mean measure was also sort of dropped below the 3.5% range. And what we've seen so far is an improvement in inflation, but it's sort of stalled out over the last 6 months. And what we're really looking for is a convincing, decisive move showing us that that stalling out has ended and we're going to track back to that 2 to 3% range in a timely manner.
Yeah, there's another survey today, NAB's business survey, and it looks like business confidence and conditions are on the way back up as well. Price pressures seem to be slowly abating. So it's a bit more good news too.
That's right, and I think this is sort of that soft landing we're really looking for. We're trying to achieve this disinflation back to target in an orderly, timely way that doesn't disrupt the wider economy too much, particularly as it relates to the labour market. So I think from the RBA's perspective, that's almost the ideal mix they're looking for, which is confidence subdued but not unduly weak, conditions sort of flat but not really contracting, and meanwhile this inflation is continuing to track lower. The final goods prices measure of that survey track back to 2.1% annual inflation. So that's a pretty convincing sign that we are going to see that move back below 3.5%, back below 3% for inflation eventually. We've just got to see the hard and fast evidence, I think, for the RBA.
Well, look, this morning the RBA released its board minutes, and I think one of the good signs was they didn't think about lifting rates at the previous meeting. What did you read into the minutes today?
Oh, look, it's still baby steps in terms of where the RBA is going. They're really sweating on this September quarter inflation update to provide that decisive signal that inflation is tracking convincingly back to that sub 3% pace. We think it will deliver that. Annual inflation will drop to around 3.5%. And on the 6-month annualised basis, we'll be back at about 3%. And that'll be a lot of comfort for the RBA that they will be able to achieve their targets in a timely way.
Yeah, that quarterly CPI number, I think it comes out at the end of this month. So that's basically critical, isn't it?
Absolutely. And that's going to be what's going to be hotly debated at the next RBA board meeting. I suspect they're still going to want to see more before they pull the trigger on rates. So next year...
You think they want to see 2 quarters of those, or...?
And some evidence from the national accounts. So we'll get that ahead of the December meeting in early December, and that'll provide the whole perspective. You've heard a lot about productivity growth and unit labour costs and domestic sources of inflation. They'll be looking to see some comfort around that, around wages, before they're not going to be hurried on this path.
Yeah, it seems funny. It seems like consumers think the Reserve Bank is probably ready to start cutting rates, but What's the outlook from you guys for where you think the RBA will go?
We think they'll make their first move in February, but between now and then we'll get the inflation update that will start to see some more meaningful shifts in rhetoric. We've seen some maybe slight clues that the board has started to shift its discussions. It didn't consider a rate hike at the last meeting, and the minutes were a little bit tweaked as well. But I think they're still sweating on that CPI number where they can sort of start to step back from the vigilance, start to maybe rule out further rate hikes as being necessary, shift to maybe a neutral easing bias, and then once they get these other bits of information that confirm their hopes that inflation's back under control, they can start to signal, well, maybe there'll be scope to ease. And next year we think is when it all gets across the line.
Does their job also get more difficult when you see the US Fed cutting rates and other central banks cutting rates and those economies starting to pick up and accelerate, but ours still with the brakes on?
They probably not too much. They've made it pretty clear in their communication that they're not too worried about what's happening abroad. They're saying we're taking a different path for policy. We never tightened as aggressively, and so conversely, we're not having to unwind as much tightening on the other way down. I think at the margin, it's probably a little bit uneasy to be, if you were tightening in this situation, you would be really sticking out a long way, and there would be questions around why exactly you were doing that and what was the nature of the homegrown issues that were behind that. Unfortunately, we're not in that position. So I think it's something they can cope with for a while, especially if they eventually start to move into an easing cycle.